All right. Well, good morning. Thanks for being here today, guys. We've got, why don't we introduce you guys? Introduce yourselves. They're from Empire.
My name
Go
is
ahead, Byron.
Byron Crow. I'm a managing director, capital markets. Uh, Randy and I have known each other over 20 years, and we're based in Scottsdale, Arizona.
All right.
And thank you for joining us today, Randy.
Yeah, hi, Randy Grudzinski, partner at the Empire Group of Companies. 20 years, Byron. God, you're aging us. Yeah, but like I said, I'm a partner at the firm, and just a little bit about our firm. I guess, according to the Phoenix Business Journal, we're the sixth largest commercial developer in Phoenix Metro, but we also develop projects around the country, mostly on the multifamily side. And we have about $3 billion worth of assets, which means we've raised about $1 billion of equity from individual accredited investors, clients similar to those of yours, Wally. So,
Absolutely. And Empire, how long has Empire been around itself?
it was founded by my partner, Richard Felker, back in the 70s in Milwaukee. And then, he was always vacationing down in Arizona, and eventually he moved his business down to Scottsdale. He always jokes that back when the company was in Milwaukee, there were about 1 million people in Milwaukee Metro and about 800,000 in Phoenix Metro, and now there's 800,000 in Milwaukee Metro and about 5 million in Phoenix Metro. So pretty smart decision on his point to move to a market where there's a lot of people moving, and obviously with where everybody's moving, a need for a lot of residential assets, and that's really what we focus on mostly on.
Abs- Absolutely. And you guys have been working together for 20 years?
We have, which is it's amazing, right?
Well,
And we're still friends.
I was going to say, I know you both. I think there must be a lot of patience involved there. So that's
It's like a marriage,
absolutely. So has Empire's mission been the same the whole time? Is that what they got into originally, or has it shifted a little bit?
People, I mean, we've always been developing projects. Like I said, started in the Midwest, and then with people moving down to Arizona, we did the same. How most people know about us in the retail space, the individual investor space, is we saw an opportunity back in 2009 during the great financial crisis. And I think we all have some scars and still can remember what was going on back then.
Oh
But in
yeah.
Phoenix Metro, 1 out of every 4 homes went into some form of distress, either late payments on mortgages, or they became short sales, or in worst cases, they became foreclosures. And being real estate developers, we saw a unique opportunity there, and we started buying single family homes from the banks, homes that unfortunately went into foreclosure. And so, from a period about 2009 through 2012, we raised a couple $100 million from individual investors and purchased about 2,000 homes in this market.
Oh
At one
wow.
point, before the big Wall Street guys came in, we were actually the largest single family landlord in the state of Arizona. And so, although it was very tragic for a lot of people who lost those homes, we actually provided a great service for them because we took the homes and turned them into rentals while we were
Okay.
holding those assets. And so for people who were unfortunately got caught where they had, very little money down, the home went down in value, their equity was wiped out. It's what they call a non-recourse state. They didn't have to declare bankruptcy. They just threw their keys back at the bank. Well, they needed a place to live. They just went down the street and rented a very similar home from someone like us. And so they were able to keep the same schools, the same neighborhood. And then, 4 or 5 years, they cleaned up their credit and they were in a much better situation.
Yeah, that was a tough time for the country. That's for sure.
Very much.
Yeah.
and after that, Wally, we ended up buying land, entitling it because the home builders didn't want to keep it on their books. So the next iteration, after all those cheap homes were, all those foreclosures were purchased, we ended up buying land, entitling it, and then selling it to the home builders, which is where we found that single family built for rent community that we now focus on and
Yeah,
started off.
it was really a nice combination of two things. Think about us. We owned 2,000 homes in the valley, and from
Mhm.
the revenue side, it was a great business model. These people were older and a little more, your typical renter in apartments in their 20s. These are people in their 30s. They have jobs. They're much more stable renter base. They're quieter. They treat the asset well. They pay their rent on time. So it was actually a much superior sort of asset class to traditional apartments. The problem was, imagine having 2,000 homes spread out over a metro area of 5 million people.
Oh
No
yeah.
two assets are the same, different appliances, different air conditioners, so on and so forth. So the whole idea of creating single family built to rent, which essentially single family homes to rent, little tiny cottages, but packing them into a 20-acre area was a way of getting better economies of scale on the cost side.
So you guys had 2,000 homes. That's and this was all just in Arizona, or had you branched out at that point?
That is correct.
Just in Arizona. All right. And then, so tell me a little bit about the history of the developers getting away from land banking for themselves. Was that pretty much 2009, 2010, or when did they start unloading that?
Yeah, so think about it as a couple phases here. There was that phase from '09 through 12 where there wasn't really a lot of credit. A lot of home builders actually went out of business then, right? So home building essentially stopped in the valley. And then so coming out of that, so we're buying foreclosed homes between 2009 and 12. Really around 2013, we saw an opportunity. If you view the value chain before you can start building houses again, which we knew was going to have to happen, what's the furthest upstream? You got to get land.
Gotta
You
have
have
the
to
land.
entitle
Yep.
it and get it zoned and permitted so that, see, home builders usually don't want to take on the land risk. They rely upon land people to buy let's say it's 20-acre farm or something like that, a little further out, and get it rezoned from agricultural to residential and get all the permits you need and have it all platted for individual lots. So we
Hmm.
saw an opportunity to do that. Always, I guess the theme, Wally, is trying to be a couple steps ahead of where the market's going to go.
Sure.
And so we knew that the home builders were going to start building again. And so we wanted to be the upstream supplier of that.
Would you go as far as getting it permitted, getting it entitled? Would you do improvements also for them or not?
We gave them essentially what would be called paper lots. So it looks on
Okay.
paper, everything's approved, but we didn't put the actual, you know, sewers and gas and utilities and stuff because that's really what they do. They just didn't they wanted to have it basically de-risked.
Okay. Very good. And so of those 2,000 homes, how long did you have? Do you still have any of them?
No. We sold them off. We harvested them I'd say between 2012 and 2016.
Okay.
Funds we sold off individually. Most of them we sold off to the larger Wall Street buyers, which you all read about now in the journal, that continue to buy single family homes around the country.
Oh, yeah. Yeah. So then tell me, let's start talking then about the apartment buildings on their side, I think is the way you put them at one point, the build for rent.
Correct. So the best way to think about built for rent, people try to make it sound more complex than what it is. Just think Goldilocks, right? You have a for sale home on one side and you have a traditional apartment on the other. And so this is something that essentially sits in the middle. It's sort of a transitional piece, either for
Hmm.
people who want to go from apartments to a home, but either they haven't saved enough money for a down payment. Maybe they're paying off student loans or college debt. Maybe their lives are in flux, right? They've relocated, or you're waiting for your wife to finish some maybe graduate education, and you just don't feel like you need to buy a house yet. Or on the other side, people who have homes and they just don't need or want a home anymore. They have grown children, they want to travel, they want something lower maintenance. And so this asset class in the middle, which is basically a rental home, had always been a mom and pop cottage thing. I'll bet you some people watching this, they go, oh yeah, I own a couple small homes here and I rent them out. It had never been institutionalized, right? And it wasn't until the great financial crisis sort of showed there's a tremendous amount of demand for people who want to be in a house and don't want to own it, right? And
Yep.
so the idea was, how do we get that to scale out? And that was the idea of build for rent. And the name is pretty self-explanatory. It's a home that's not built for sale, it's built for rent.
Sure. When did you start? When were your first ones?
Yeah, the very first ones were started in, call it 2016, 2017,
Okay. So ahead of COVID.
as an asset class. It's funny because if you looked at it on paper, it's really an apartment building. People pay rent, they sign 1 year leases, they get a pool, a clubhouse, all the other stuff. So I tell them the way to visualize it, instead of 2 acres and 200 units on 5 stories, imagine 20 acres, single story. And they're small. They're little cottages packed in at about 12 to the acre, but it's almost like you took the apartment building apart and you just sort of spread it out. It
Sure.
has the same
Sure.
amenities.
So that was so that was well ahead of COVID then, and then that really
Yes, it was. And then COVID sort of really accelerated the trend,
Yeah.
because there were all of a sudden these people saying, I don't want to be in a dense apartment building. I want to be in a standalone unit. The whole idea of social distancing, you might remember that terrible phrase. Well,
Yeah.
this was very much akin to that, right? And that's what really, we had a concept. Couple us, Next Metro, Christopher Todd, Cavan, we're only three or four of the early players. We're very nascent in sort of proving out the concept. And it wasn't until COVID hit when we had this big inflow of demand that this asset class really became institutionalized. Lenders were willing to lend against it. Municipalities, they didn't even have anything on their books how to actually zone something like this. There was no
Sure.
classification for it. So there was a little bit of evangelizing and get no different than crypto, all this. Now it's fairly well understood, but back then there was a lot of evangelical work to get people to understand it. Same thing with build to rent. And so COVID was the catalyst that allowed that to take off.
So, a couple of the observations, if I remember correctly, I think at one point I saw that the typical apartment, this was maybe 2-3 years ago, typical apartment was like $1.25 per square foot, whereas the typical build for rent was more like 80 cents a square foot and a little bit of a yard. And I don't know if those numbers are, specific anymore, but just in the industry in general, being able to have the apartment building on its side, being able to have a small single family home that's and oftentimes in a gated community, better security, a little bit of space between you and your neighbors, that sort of thing. It was such what a better value all the way around.
It was. When we do surveys of our tenants every year, and they come back and they usually say the same things. Well, why are you doing this, right? And it's basically because it's safe, secure, and quiet. All right.
Yeah.
People want a large segment. Actually, our largest segment. You'd think it's young couples with dogs, or maybe older people downsizing, but it's really single professional females. And if you know of any female in your life that's 28, 29, 30 years old, they might make a pretty decent income. They don't need to buy a house, but they sure as heck want to get out of an apartment. They don't want to go in that dark parking garage. They don't want to walk their dog out at street at night. There's some strange gentleman who lives next door who's always, asking to borrow something or chatting you up at the pool. And so instead, and we all smile because we know this story, instead you get your own little cottage. And I always compare, we also develop regular apartments. And when you go to one of our apartment buildings at 6:00 p.m., it's Grand Central Station. People coming and going, heading to dinner, this and that. You go to one of our built to rent communities at 6:00 and it's absolutely quiet. And so it's this sense of security, just a quieter place. It's the same reasons why you want to have a home on your own.
And every one of them has a security system. So you've got the Nest thermostat, you got the Ring doorbell, and that just adds the security.
Very nice. And there's and about 20 acres typically on one of your builds, maybe
plus or minus. I think it's 200 to 250 units, 20 to 25 acres. It's a good, that's sort of the sweet spot. So
right. And the size of the unit, are these one bedroom? You keep mentioning cottages. Are they 1, 2, 3
Very
bedroom?
Good question. We intentionally mimic the floor plan of a traditional apartment building. So if you had a one-bedroom apartment, it would be 700 square feet. That's what you'll find in a one-bedroom. The vast majority of our units, 60 to 70% of them, are your 2-bedroom, 2-bath, about 1,100 square feet. And then we have some 3 bedrooms that are 1,350 in terms of square footage. So I guess if you wanted to position us, we're positioned a little closer to an apartment. We're not designed, this isn't 2,400 square feet for husband, wife, 3 kids, 2 dogs, and a parakeet.
Right.
It's designed much more for those people transition. Again, we always say everybody in our units has a 2-legged or 4-legged dependent.
Sure.
It's generally a toddler or a dog.
Okay. So I think the one of the breakthroughs is the compared to having 2,000 units that are just random all over the town, no two alike, that kind of thing. This is this cookie cutter mentality where, okay, all the AC units are the same, all the garage door openers are the same, the appliances, I mean, the efficiencies, being able to buy in bulk and maintain in bulk, I think I think that's great.
And for a buyer who's going to buy these communities, we're developers. We build them, we lease them up, we sell them off to a pension fund, endowment, a foundation, insurance company, somebody who wants
Sure.
to own this for the cash flows. Although they love looking at and modeling out what they think rent growth is going to be, just as important is how can this be efficient from the cost side? So when you have the same Samsung appliances, there's only 3 unit types. It's a 5-minute walk for a maintenance man from one corner to fix a toilet here to change a light bulb on the other side of the community. It's
Nice.
just a very scalable, efficient way. But like you mentioned earlier, yet we capture about a 25%, 15 to 25% rent premium over a traditional apartment. What that basically means, if someone's going to pay $1,500 for a 2-bedroom apartment, they'll pay 1,800 to $2,000 to have their own little standalone,
Nice. Yeah.
their own little backyard instead of a balcony, their own sense of privacy. That's the premium we get versus a traditional apartment building.
So, Arizona, where else are you?
This asset class was invented in Arizona. And so we have 20,000, there's 20,000 units here in this area, and it went from no units in 2017. So it's become the darling of that. And
Wow.
it only makes sense that us and our competitors would want to go to places that are sort of seeing the same type of inflows of population, the same growth. So when you look at the electoral map from this recent election, if
Yeah.
you look at the states that Mr. Trump won, versus the ones that he didn't, that almost looks like the maps where the build to rents are going. So people are moving to Texas, Florida, and Arizona primarily. To a lesser extent, but still a lot, is where you are. They're going to Colorado, they're
Yeah.
going to Tennessee, the Carolinas, so on and so forth. So we have a number of projects in Texas. Some of our competitors have gone to Florida. It's a little further away from us. And then we actually love, we love the north side of Indianapolis. We have a couple projects up in Hamilton County, and you read the journal lately, it's actually the fastest growing metro area in the Midwest because it's surrounded by a lot of blue states and a lot of white collar jobs there and a lot of rent growth, a lot of income growth. And the 4 towns in the county on the north side of Indianapolis that we're building in rank out of the top 1,300 small cities in the US. All 4 of them are in the top 20. And that's population growth, low crime, good schools, good incomes, so on and so forth. And that's a market that only has 2,000 built to rent units. So I guess the theme here is this is starting to move into other markets as well, and we're moving with it.
So, where do you feel you are in the business cycle for this particular concept?
So I think we are, if you view it like a 3-act play, we're at the end of the first act.
Okay.
The first act was sort of just perfecting the asset class. It's a concept. It's no different than Elon Musk right now. He'd say, yeah, I'm getting close to the first act, which is this starship now goes up pretty well, pretty consistently. I've proven it out. Then the next act is now he's going to scale it out. He's going to send one up a month. I think he said 2 years from now, he expects to send a whole bunch to Mars already, right?
Yeah.
So now we've sort of perfected the asset class in the first act. The second act now is we got to get it out of this incubator, which is in Arizona, and we got to start rolling it out around the rest of the country. If it works here, there's no reason it wouldn't work in Nashville, Austin, Dallas, Orlando, Atlanta. And so that act, given just the size of that market and how many people are moving there, is going to last through the rest of this decade. And then I think that third act, which always happens in any industry, is once it sort of gets commoditized, then it starts becoming a little bit more competitive. No different than the laptop industry or whatever it is. And that's probably going to be into the next decade. And also with that competition is more specialization. They're going to start looking a little different. People are going to start micro segmenting the market a bit.
Oh, sure. Yeah.
But right now we're just starting that middle act, which is sort of expanding it and scaling it out.
I think one of my favorite Churchill quotes was he asked if this is the beginning of the end, and he says, no, this is probably the end of the beginning.
That's exactly right.
So,
and that's where we are. This asset class is now, what I'm saying is municipalities now understand it. Lenders are comfortable lending against it. The metrics, so many of these assets have been built and sold. They know how to basically model it. And so once you've had that machine sort of perfected, now it's how do we take it to Tennessee? Texas, Oklahoma, Florida, the Carolinas, and that's what that's what you are seeing, and you're gonna see for the rest of the.
Well, and again, we're not getting into product specifically today, but I know you guys have been pretty good about creating different ways for investors to participate, different asset classes, for
That is
example,
correct.
or
That is
share
correct.
classes, and so that's something we can discuss with
Well,
anybody in
I can talk at a
particular.
very high level. It's all about your tolerance for risk. So,
Yeah.
we borrow money as a senior lender, no different than when you buy a house. You have a mortgage, they have a deed to the house, they get paid back first, right?
Mhm.
Whatever happens. So, we'll have a construction loan. And then after that is the equity. And instead of just saying, oh, you're all in the same pool, I have some people that are saying, no, maybe I want to maybe I want to get paid back second,
Mhm.
but ahead of another tranche of equity, but I'm willing to take a little bit less of a return. Or I'm
Right.
willing to say, I want some current income, and we could treat it almost like a construction loan, and we could pay you current, but you're in that second position, almost like a second mortgage. Or someone might say, no, you know what? I believe in this asset class. I like the business model. I'm willing to sit in that last position, but have unlimited upside,
Now,
okay, and
are
not
you
have my upside cap. So
With the single address gated community, I mean, the potential for that was to solve a lot of the Delaware statutory trust, single identity, identifying a property. Are you guys using a DST model for your communities?
we are not yet, although we have looked at it about as a
Okay,
way of exiting on this. And as you know, this asset class has now worked its way into the DST market because no different than apartments, it's a really good asset class. And
right.
most people would say the lenders actually favor the build to rent market even a little bit more than the apartment market because they view it as being less risky. Again, and if you don't mind me talking a little bit on a tangent, the three
No,
things
that's fine.
people complain about the most, three people look at this election. They didn't care about all these fringe issues. The three things people care about the most is their price at the pump, their grocery bill, and a roof over your head. Their
Yep.
rent, right? Because those are the three things you can't avoid. You have to have a place to live. You got to get in your car to go to work, right? You got to eat, and that's why And so when you view build to rent, it's an asset that it's one of those three. It's something someone has to have. And they might say, okay, well, so is a home and so is an apartment. But if you think about the fact that people have to live somewhere, and so when people are doing well, maybe they make a little more money. They can move out. They sure as heck don't want to stay in an apartment. They'd rather move into a build to rent. Or when times are tough and it's hard for them to get a mortgage, or like right now, mortgage rates are high, home values are expensive. Well, then they can't go into that. They got to go into a build to rent. So we're in this buffered position where we sort of win either way. And so for investors through DSTs, lenders, buyers of this asset, they view it as actually a safer asset than either end, investing in a home builder or investing in an apartment project.
Okay, 3 or 4 years ago, we got to a point where the cost of lumber and things went up 8 or 10 fold.
It
Were you
did.
guys able to hedge against that, or get forward contracts to keep your costs down, or how did you guys handle that?
There was a number of things without getting in the weeds that we were able to do. Mostly it was just buying in bulk, right? So,
Okay,
if you wanted, if you had 200 doors at your apartment building, front doors, because we have 22 projects and 5,000 doors, we're able to buy those in larger bulk. Same thing with
okay,
windows, so on and so forth. I think on the inflation front, we were fortunate enough that, when we used to build our projects for, let's say, $2 as an example, and now it costs us $2.50 or $2.75. Well, rents used to be $1.40 a foot, and now rents are 2 to 2.10 because inflation doesn't discriminate. It rises for
both
everybody. So where
sides,
our
you bet.
costs went up, our rent went up. Same reason why you got to pay more for the person to work at McDonald's, but now your McDonald's Happy Meal is $11 and not $7. So the model itself, the margins have pretty much maintained, even though costs have gone up. We've seen rents go up, right?
You bet. You bet. With interest rates, how is that affecting you guys then, as far as the cost of borrowing and any of that?
So fortunately for us yes, it got expensive for a while when rates went up because we're pegged to basically the SOFR, which is really the Fed funds rate. So the Fed went from 0% up to 5.25, and our lenders will have a spread, call it roughly 4 to 5% above that. Well, we'll buy rate caps and things to hedge if they
Right.
go up any higher. But our rates are variable with a cap, so we don't worry as much about the upside. But now the Fed is you're working on a series of rate cuts, and if you look at the dot plot, they expect us to be around between 3 and 3.5% by the end of next year, down from 5.25. Do the quick math. We're 1.75, 1.75% cheaper now as those rates go down. You know,
Well,
I
that'll
tell
sure
investors,
gives
pardon
that'll
me?
sure. I was going to say that'll sure provide some relief for the
It will,
young people who've had to buy homes in the last year.
without a doubt. I think, as investors, it's hard to, people always want to look at how things are right now. And the thing I always try to tell people and I challenge them on is, you don't care what the market's like now because we're going to build a project. You care about what it's going to be like 3 years from now.
Sure.
And
Yeah.
so we expect much lower interest rates. But and this is actually the most important thing for investors right now as they're looking 3 years out is what has been the ramifications of all this tight credit, of what's happened with the cost of capital going up so much. We're still undersupplied by about 4 million housing units here in the United States. Okay. You've heard both Donald Trump and Kamala Harris talk about it in the campaign. And sure, we're a little oversupplied in apartments now and in the call it the more of the Sun Belt markets, but that's all getting absorbed. The issue is that 3 years from now, we're going to have an even larger home deficit than what we have right now. Because rates went up so much, the amount of credit got so tight, the amount of permits have gone down. So we've seen permits fall in some markets 50%, some of them down 70% from the peak.
What's the time frame on that as a leading indicator?
Yeah. So what it means. So right now, think of the other way. There's a oversupply in the Sun Belt markets because we had so many permits in 21 and 22. Well, all those are getting delivered right now, and they're going to bleed off some markets by the end of this year, other ones by the end of next year, but somewhere in that 12-month time frame. Now, permits have fallen over 24, 25, and they're expected to fall again next year. That means you're not going to have the deliveries you need in 26, 27, 28. And so what's the real upshot is the Fed has essentially pushed down, and housing is like a third of the US economy, housing and housing related items. They had to push housing down to lower inflation. They've done it now, but then they're going to create future housing inflation down the road because of it's not a small drop off. This is the world's largest economy. You can't have permits fall over 50% and not deal with an undersupply just a number of years down the road.
Now, are you all, do you participate in the land banking? I mean, is that a part of your business strategy at all?
Well, we aren't doing it as much at scale anymore, but we do purchase the land. I should say purchase. We will tie up. We'll have a contract, and the contract will say, we agree, hey, Mr. Farmer, if you want this much, or hey, whatever, if you want this much for your land, we're willing to pay it to you, but only after we get the zoning and permit.
So you'll option it.
That might be a 12 to 18 month long escrow. We don't have our investors take on that risk. We do it with our own dime. We put in our capital. And then once we get the zoning, that's when we go ahead and launch a project, an offering for investors to participate in. And that way they're not taking that risk. But that's part of the value we create for free that the investors are able to participate in.
Last question I have, or last topic. California, boy, they have seen a lot of the legislation changing, allowing ADUs, JDUs, the densification that they need to have on the property, especially down in San Diego County, the southern end of the state. How is legislation affecting you guys? Is that opening things up? Do you look at legislative risk being a challenge?
If I could smile a little bit. So yeah, the state said they're going to allow ADUs, and then every little municipality made it so difficult that no one wants them anyway. And I think there's been like four coach houses built since California changed that law. I always laugh that state is very progressive, yet they're the least progressive state when it comes to having renters live next door to them. So there's my little political statement about California.
There you go. Well, you're allowed one, so.
Yes, right. So, Arizona and Texas, there's a reason why Elon Musk is moving out of California and going to Texas, and it's not because it's 108 degrees, right? And it's
Yeah.
and there's a reason why Taiwan Semiconductor and State Farm and all these people move here, and it's not because it's 114 degrees. It's because it's very pro-growth, pro-business, low tax.
Mhm.
And so we continue to see, and people understand in this state that we need to compete, and to compete, we have to have a pro-business environment. And that means for developers, they need to be very much in support of what we do. Now, sure, we can't go willy-nilly here. This isn't the Wild West, but it's I just in general, we're fortunate enough to be developing here where people understand that they have to support building to keep housing affordable here and keep people moving here, which is a huge advantage. We have to have a product. We just passed. Here's another example too: is that you also have to invest in growth. We just passed another referendum here. If you've ever go to Phoenix, you ever notice you're never really stuck in traffic because we spend tens of billions of dollars on new highways and new roads, putting in new infrastructure in anticipation of adding the 60 to 100,000 people a year. And we consistently do that. And we just passed another referendum, making sure that we're staying out in front of this growth and staying competitive.
Well, that's awesome. Well, I know I think the only main concern I would have if I were moving down that way would be water. Where are they going to get it from? But that's all the western states, you know?
It's a very good question, Wally. And I think a little bit of a misunderstanding here. And I'll lay it on you straight. The 70% of the water, just like in California, 70% of the water in Arizona is used for farming. And farming are the first people that have to get cut back. They just came up with a new accord, as you know, about a year and a half ago for how much they can draw out of Lake Mead and where the cutbacks are. And so we're now the 10th largest municipality in the United States, bigger than Boston's metro area. So if you believe that they're going to allow this area to run out of water, given the economic significance of it, and by the way, people making 30 and 40-year multi-billion-dollar decisions like TSMC with their $60 billion plant, and why a lot of these people are moving here, they know that we are not going to run out of water here. On my deathbed, do I believe that we're going to be growing alfalfa and cotton in the desert? I'm highly skeptical, right? So if there's one thing that will change, are we going to be, was it 20 gallons of water for one avocado in the Central Valley of California or a gallon per almond? I don't know if that's sustainable, but are the municipalities going to run out of water? I'm highly skeptical.
Well, that's a good answer. Understanding really the local knowledge about that, about how much is used, where it is, the farmers, the
You have to have a
residents.
100-year permit. We have to have a permit here for a 100-year water supply. So when you hear in the news, oh, this place is they're running out of water, it's like, no, someone decided. By the way, outside of the aquifer where there are no wells, and we get the majority of our water not from Lake Mead, we get it from groundwater and from local mountains and reservoirs.
Right.
So when they hear in the media, oh, this doesn't, it's because they're trying to build a huge community of 10,000 homes in an area that doesn't have water permits.
Okay.
Well, there's a reason why you have to get these permits, because you have to make sure that you have a 100-year water supply.
Well, we've got a very similar situation here in the Colorado area, so I think it's all through the
Yes,
West.
yeah, actually,
So,
it's a very big concern in your area, right? But it'll get managed.
Yeah.
This country has a tendency. Sometimes it takes a crisis, but we solve our problems.
well, the ones who are, I think, going to have trouble with it are those builders who are basically, it's like trying to deny the laws of physics. We have a builder here who's over in the foothills, got a huge tract of land, a big ranch, and they're saying that, our water use is going to be 60% less per household than normal. It's like, okay, you're going to make up your own facts. It's
Exactly
it's
right.
kind of crazy.
Hey, Wally,
And
here's
they
a
say,
fact for you. We use less water right now. We have 5 million people in this metro area. We use less water now than we did in the 1950s.
pretty
I'll
good.
tell you why.
Yeah. Well, that's when you.
Phoenix is where it was because there's a huge aquifer and it was an agricultural hub. So it was mostly people growing winter fruits and vegetables and cotton. Every time you put a subdivision in and you get rid of a farm, you lower the water usage by 90%. So
That's a good talking point.
yeah, our population
Absolutely.
growth actually conserves water versus it's the truth versus because you're just taking the farms that were there aren't farming on it anymore.
Very good. Well, I think those are some talking points I'm going to learn to share with my clients a little bit more.
Good, good.
So,
Can I inject one more advertisement if I could, really quick?
absolutely.
Yeah, look, I think your best opportunities are where credit is constrained. And so you saw like we credit constrained on apartment building. You care about 3 years from now, we talked on this topic. During COVID, they stopped building hotels, and try getting a hotel in a city right now. Go anywhere, $800 a night, sometimes as much as 1,000. Didn't build enough hotels. When COVID hit, they stopped financing senior housing. And the baby boomers, they're turning 80 at an amazing pace right now. I mean, we are the 55 and older product, senior housing, runs out of capacity. It means there's no room at the end by 2028. There's not going to, because they have not invested enough in that space.
Well, we're peak 65 right now, so
yes, it's undeniable. I mean, think about it. And actually, it's too late right now. It can't be solved. You're going to see very substantial rent inflation and rent growth in senior housing, because even if $200 billion flew into that space today, you're not going to see those units delivered for years down the road.
Sure.
And so you're going to see that same supply crunch happen. And I think Green Street, who's a large advisor in this space, they're expecting 11% NOI growth every year for the next 5 years. NOI growth is like it's like rent growth.
Oh, yeah.
So if you have 10% rent growth over the next 5 years, you compound that. That is, I think of all the asset classes, 3 to 4% rent growth, 10% plus in senior housing. So,
well, you combine that with lowering interest rates, it's a great place to be an equity player.
It is.
Absolutely. Good deal. Anything else you want to share? I think that was a pretty good overview.
We love the asset class. There's been no 10-year period since they've been tracking this where real estate is worth less at the end of that 10-year period than it is at the beginning. So
I remember they used to say,
even through the S&L crisis, even through the great financial crisis, through COVID, it's an asset that's a need and not a want, and it always snaps back.
Yeah, there you go. They used to be able to say that about the stock market, and then they had to change it to there hasn't been a 12-year period.
12 years, you just spread it out a little bit, but you get there. Right? Money has to find a home, though, right? So.
Absolutely.
There's one other opportunity with this investment is potential Roth conversions.
Oh, yeah.
Wally. And, in the common equity, we do revalue the asset when it's coming out of the ground and we've spent most of the equity. We'll go get it valued. And there is that potential for a Roth conversion as well.
We've got a very nice white paper on that. Talks about that strategic Roth conversion through the equity play like that. And I know you guys have been one of the leaders in that space, so that's wonderful. Anyway, well, thanks very much. We'll do this again, probably a quarterly basis. Keep up with you guys and appreciate the time.
You know where to find us. If anybody has any questions, please reach out to us. Like I said, it's always important to make educated decisions, and that's what we want to do. Is make sure people are being informed. So, thank you, everybody.
Right. Wonderful. Have a good one.
Take care. Bye-bye.
Bye.
Impact 1031 has a DBA of Ridgegate Financial, LLC. Not an offer to buy nor a solicitation to sell securities. All investing involves risk. Past performance is not indicative of future results. Speak to your finance and/or tax professional prior to invest. Securities offered through Emerson Equity, LLC. Member FINRA SIPC. Only available in states where Emerson Equity, LLC is registered. Emerson Equity, LLC is not affiliated with any other entities identified in this communication. Investment advisory services offered through AE Wealth Management. Emerson Equity, Ridgegate Financial, and AE Wealth Management are not affiliated entities.